So Scott, we have a lot of things to talk about and not a lot of time to do it. So I want to be rather efficient with the conversation today. I know we want to talk about a digital marketplace bank, but I first want to get to the state of the US consumer. And I want to put that into a little context because I'm sure that it has an implication obviously on what the requirements are now of a bank that can adapt to what the consumer's constraints are and may be going forward, as well as your core business. So let me paint the picture. So here we have a macro environment, as all of you know, that is challenging. We have inflation that we haven't seen in 40 years. We have interest rates rising, obviously will continue to rise as the signals tell us. We have businesses that are margin constrained, so they're looking for ways to keep their cost in check. Yet we have a consumer that's employed, record levels of employment, consumers are spending, the economy is strong. So given all of those signals, how would you define the state of the US consumer?
Pretty solid but changing is what I would say. You know, looking at a longer arc, we've seen over the last 20 years, lots of expenses increasing, healthcare, education, housing, and incomes becoming more volatile, I would say. But coming into the pandemic, consumers were actually pretty well situated in terms of household debt levels and debt to income. And they actually came out of the pandemic or in the process of coming, I'm not sure where we are, but actually got into better shape, right?
We're in endemic. It's endemic.
Endemic, okay. So, you know, delevered, you know, paid down their debt, built up savings. But what you're seeing now is as government support has subsided and cost of living has been going up and outpacing wages, which have thankfully started to move, you are certainly seeing, especially the more vulnerable part of the population, kind of back to where they were pre-pandemic already.
You know, the work that we've done together to profile the paycheck-to-paycheck consumer, I think is really interesting because it has, I think, awakened everyone to the notion that it's not just a certain subset of consumers that live paycheck to paycheck, that it really is a financial lifestyle for many consumers who can pay their bills but need their paycheck to do it. And you know, we look at this every month, and it's about 2/3 of the US population. It's 50% of those roughly making $100,000 a year or more. And it isn't as if they are struggling to meet their bill payments, but they need, as I said, the paycheck to do it. How do you think that consumer classification, that class of consumer, is now being challenged with all of the different things that we talked about? I mean, obviously, they're making good money, they have good credit scores, they have credit available to them, but...
Yeah, so that's, it's an interesting thing, I think, you know, hopefully somewhat unique to the US, but, you know, if you look at our customer, people are often surprised. Our average customer is earning over $100,000 a year. Their average FICO score is north of 700. And people say, wow, why would a consumer like that have credit card debt? Why would they be living paycheck to paycheck? And to your point, it is, you know, it's kind of going back to these trends over time, which is a lot of expenses going up. And also just the need for the US consumer, unfortunately, that the more money you're making up until you reach a certain point of wealth, the more debt you actually have. So higher income means higher credit card balances, higher loan balances, bigger student debt, and bigger mortgages. And so that consumer is able to meet their obligations, they're overall financially healthy, they've got savings. However, in this environment, right, there's going to be a need to really relook at what they're prioritizing for spending. And you're starting to see that already, right? If they have credit card debt, those credit card levels are now back to pre-pandemic. So there's over $1 trillion in credit card debt. Those rates are going up, so they're going to see those bills go up. So you're seeing consumers, you saw this in some of the retail earnings that came out, really change what they're spending on, going more towards store brands, moving away from some of the discretionary spend, just to make more room in their budget.
Yeah, we've seen that too in our data. You know, we saw the spike up back in March, April, where consumers were going to the grocery store, spending more, about 10% more. And then the next time they went to the grocery store, we see them spending about 10% less, but buying the same amount of things. So they're actually going away from the brands that they used to buy, trying to save money in any way that they can. But how does this shock, which is, I think, something that consumers probably didn't expect to see in 2022. I mean, I think we all thought 2022 would be a different year than it has become.
Yeah.
And yet all of these things now, the supply chain issues continuing, the inflation, which is taking more of their paycheck. How is that affecting your business?
Well, for us, our primary use case where we kind of built the business around was actually going to consumers who have credit card debt. About half of all Americans who have cards are carrying a balance, and that's effectively a loan, and it's a crappy loan. And so our business is going to them and saying, hey, do this instead. We'll lower your costs pretty significantly by about 400 basis points. It takes 2 minutes, and on average, consumers also see an increase in their FICO score. So the growth in credit card balances is actually a tailwind for our business because it means there's more people that we can help, and the fact that rates are going up is also a signal to them that maybe I should do something about this.
And so is that what you're noticing?
It is what we're noticing, and we recently, and coming out of Q1, actually raised our guidance based on kind of what we were seeing in the overall market. But to your point, we've got to be very prudent. We feel good about the state of the consumer. We feel very good about overall health of credit, but we're being pretty proactive around, really stressing how to think about cost of living going up, making sure people can afford higher home payments, higher prices, resumption potentially of student loans. All of those things are factoring in.
So let's now move to the kind of financial banking support that consumers may be looking for, and how a digital marketplace bank may address some of those concerns. And I want to put that in a little bit of context as well. We've done a lot of work to better understand how consumers want to manage what we call the connected ecosystem of their daily lives, what kinds of things they want to see together in a single digital front door to make it easier for them to manage finances, spending, and so forth. And what we've learned is that 25% of consumers in the US want a better handle on their financial health, and they actually are looking for financial services providers who can help them do that. Not just a place to park their money, but an opportunity for them to feel better about the financial decisions that they're making before they spend. And so I'm curious, given that as a backdrop, how does a digital marketplace bank fulfill the needs of what 25% of the US population says they want?
Yeah, so as I mentioned, our history is in lending, right? That's where the money is made in banking, and that's kind of how we've built the overall business. But with the acquisition of the bank, we now have the ability to move and help people manage their spending and their savings. And what we're hearing loud and clear from customers is it would be great if somebody could make it easy for us to make smart financial decisions. These consumers they have their own systems, right, to manage all the bills that are coming in. But somebody that could help just look at it and say, hey, as an example, you get paid on the 1st, but your mortgage is due on the 28th. Maybe you should change that payment date to be after your payroll date to make sure that that's taken care of at the moment you get your paycheck in. Looks like you've got an auto loan. You could save quite a bit of money, refinance that, and we've got all your information. You're pre-approved. Just make it easy for me to do that. So we're hearing that from our customer. That's kind of the work that we're doing, is to try and just make it very easy to make good financial decisions and leverage what we've got, which is a vertically integrated model, right? Where we don't have the branch infrastructure, we're digitally native, and we're able to just kind of look at the data of the customer, look at their spend profile, their income profile, and help them navigate.
How is that different than what you hear from other digital banks and traditional banks in trying to address some of those same things. Is it because your focus is more on the outcome that a consumer wants, which is, I really have opted into being financially healthy, as opposed to opting into, I want a different product?
Yeah, so versus the digital banks, the big difference for us is where most of those inroads have been made is in the underbanked consumer, who were being kind of feed to death by the core banks, and they created an experience to help people get access to their wages early, avoid overdraft fees. That's not our customer. Our customer actually is served by the banks, just very poorly. And so that's who we're reaching out to, with the focus, again, on lending. It is a very interesting statement about banking in the US that existing customers at a bank get paid less for their deposits, and they get charged more for their loans than new customers, right? And we're trying to flip that on its head and say, hey, come to us. We're going to treat you. We're going to reward you for the business. We're going to look at your whole picture and make it, like I said, make it easy for you to make good decisions. And the value that you bring to the bank, we will bring back to you in the forms of savings.
I think about what we talked about, which is the pressure on consumers to manage their money paycheck to paycheck. We talked about how this might be able to adapt what's due to what's coming in. But I'm wondering if there's other things that, because you're helping to lower the cost of credit, that what consumers are saving is actually saved. So how do you actually build that bridge and actually create the action to create the savings that obviously consumers need and want?
So, a simple example would be somebody comes to us and we say, hey, you can keep driving the same car, pay off the loan in the same time period, but we can lower your rate. We can save, on average, we save people over $80 a month. What we want to build is an experience that says, hey, rather than lower your payment by $80, why don't we lower your payment by 40? Well, let's take another 40 and put it into a savings account for you, where you can earn, where you can earn interest on that. And if you're one of the 20% of Americans that had a medical emergency in the last 5 years, and then you needed to use a credit card to bridge that, you don't have to do that anymore, because we've built up a savings for you that allows you to access that. So that's exactly what we want to do. You
call that intelligent finance?
Yes. It's basically trying to create a seamless experience for people powered by business intelligence that just makes it very, very easy for people to do smart things with their money.
How different are the LendingClub members from the digital bank customers?
Yeah, pretty different. So as I mentioned, high income, you're talking over $100,000, high FICO, so very creditworthy. And these are not millennials. Our average customer is between 40 and 50, which is the age at which you've built up a credit history, right. And unfortunately, you've also built up some debt. So that's who we are reaching. We've got about 4 million members that fit that profile.
And do you think because when you look at the digital banking landscape, do you think it's because the way that those members, you call them members, find you is because they're looking for alternatives to existing credit, either to consolidate debt or to look for a personal loan for something of significant value? And that creates a wedge, a relationship that you can then build around, and that's different than what other digital banks have started out and their value proposition? Yeah, so it's exactly right. This is a very high value proposition, right? We're not just a place where you can keep your money, we're a place that will actually give you money. We're going to give you money that is going to be at a rate that's generally better than you can get anywhere else. And we make it really easy for you to do so. It's going to improve your credit health. So it's our first interaction is welcome to LendingClub, take 2 minutes, we're going to save you money. It's very positive. And we're going to give you money.
And we're going to give you money. And as a result of that, about half of our customers come back within 5 years to do business with us again. And that's, even with the more pre-bank, the more limited product set. So our goal over time, as I mentioned, is to move into other parts of their financial life. That's the strategic value that the bank gives us, one of the many.
How would you handicap the digital banking landscape today, and then the digital banking landscape as you think it will evolve 2 years from now?
That's a great question. I mean, there's been a ton of innovation that's been great for consumers, right? And it's really altering the bank landscape across all banking, not just digital banks. We talked about, overdraft fees and better seamless experience. The pandemic has really accelerated this move to digital, and people realize they used to choose their banks based on the branch location. But now banking isn't a place you go, it's a thing you do, and it's increasingly on your phone. And so people are now seeing experience as a key differentiator. So that's great. What you're seeing in the space now is both lots of people, many of them here, that are creating software platforms to help especially regional and community banks compete with a solid digital experience. And you're seeing a lot of digital banks it reminds me of if you remember the first wave of the web, all the dating sites that proliferated, serving all these different audiences.
I wouldn't
I
wouldn't know.
Yeah. So you're starting to see that in banking, right? Banks specifically for freelancers, banks for small businesses, right. Banks for teenagers, and each one coming with a unique value proposition. And the exciting thing, I think, for these new digital banks is they're starting with a fresh, clean sheet of paper, right? They're not encumbered by green screen technology, legacy core systems, and they're able to innovate quickly. However, the question is, what's the business model there? Right. And so if I look ahead and we think about what, by all accounts, is going to be a more difficult fundraising environment and, potentially a more difficult business environment, how you turn a great user experience into a great business will be the challenge that a lot of them are going to have to tackle.
So you've mentioned in previous conversations that you are a profitable bank, profitable business. And so I read something in payments.com, you guys probably know that publication, that JP Morgan said that they are going to, in their UK digital bank, probably rack up about $1 billion in losses before they turn a profit, maybe 2026, 2027. So as a profitable bank, what tips can you give JP Morgan?
Jamie has not called me yet for my advice.
Well, he might now.
But look, I think it's fascinating to see. You saw, you heard him talk pretty openly about the need to invest in technology, right. And the great thing about JP Morgan Chase is they can afford to do that. I think the question is what happens to the smaller, as I mentioned, the smaller community regional banks, their ability to keep pace. I think the question with a new digital bank is going to be, how do you differentiate yourself, right? The market is certainly quite busy, and the UK has seen a lot of innovation in the digital bank space. Chase obviously had some efforts in the US with Fin. So there's coming up with the idea, and then there's executing it well. So it'll be very interesting to watch. They certainly have a lot of smart people, and they got the capacity to invest and build.
I think, before we move on to the next topic, I think it is the business model. It's how you make money, and it has to be beyond the interchange model and just a foundation that creates a richer set of opportunities to monetize that consumer relationship. So marketplace is a key word between digital and bank.
Yep.
That you say creates the differentiation and distinction in what you're taking to market. There was an announcement earlier this morning about LCX.
Yep.
And the innovations that you're making within the marketplace for LendingClub loans. Tell us a little bit more about that, and how does that help advance the mission of the digital marketplace bank?
Yeah, so the marketplace is how we got our start. And what that does is we've attracted this very, large ecosystem of investors. It includes banks and insurance companies and asset managers. They are all competing for the asset, for the individual loans for the borrowers to earn the return on that. And what that does is it drives down the cost of borrowers through that marketplace model, and it also allows us to serve a broad range of borrowers. I talked about our average profile, but we're able to serve a broad range of borrowers across the spectrum because we have banks and credit unions funding 800 FICO borrowers and asset managers funding 700, and we've got other funds that are able to underwrite riskier borrowers. So that's what the marketplace does. LCX is effectively an electronic exchange where the loans are posted, and investors are connected via API, and they can, buy the loans. There's no, files going back and forth through email and Excel spreadsheets with millions of lines. It's basically loans get posted. Investors can buy them either at fixed price or in an auction format. And what we announced today is we're enabling our clients to actually sell assets to each other. So if an investor is looking to rebalance their portfolio, wants to buy more from another investor, seasoned loans, or potentially sell their portfolio, they can do that. So it increases liquidity within the asset class, also allows for price discovery for us, right? We can see what loans do investors want, which ones are they paying a premium for, what loans are being bid up, and that gives us a signal about maybe we should go create more of those loans. Maybe there's some more value we can give to the borrower there to help do that. So it's a pretty powerful mechanism. And we've now augmented that with our own bank balance sheet. So we keep now about 20 to 25% of the loans we issue. And what that does is, one, it's higher earning. We earn about 3 times as much on the loans we hold as the loans we sell. And it shows our investors that we're eating our own cooking, right? So that we care deeply about the credit quality of these loans because we're holding them too.
I imagine that you also get a lot of insights into what investors are looking for and how that changes over time. So what are you seeing now?
Well, investors are seeing, again, depending on what kind of investor, banks have not yet seen their cost of capital go up. They're sitting, frankly, in many cases, stuffed with deposits that haven't moved yet. But some of the other investors, especially those that rely on leverage, are seeing their cost of capital go up. So what they're looking for is they're looking for the yield in the loans to go up, and they're also looking at things like capacity to pay. So we're seeing that very much play through the platform right now today, and expect that's going to continue. The good news, again, for our core business is credit card rates are going up, so we have the capacity to raise rates to borrowers, give investors returns, but also still provide value to the borrowers. Which, if our business was mortgage refinancing, would be pretty difficult.
That would not be a good business to be in right now. So what is the behavior of the LendingClub consumer or the prospective customer? What are you actually seeing now show up, and how does that align with what investors are looking for?
So we are still seeing in our core portfolio, we're still seeing the effects of this period of artificially restricted spending show up in credit outperformance, right? Consumers' prepayments went up during the pandemic. People used their extra cash to pay down their loans. We're still seeing elevated prepayments. We're still seeing delinquencies below pre-pandemic averages. But we are seeing it start to revert more to the mean. And where you're seeing that happen more quickly is in that population where you would expect it, which is the higher risk borrowers who are going to more feel the cessation of government benefits, and they're going to more feel the pain at the gas pump and in other places.
Do you think that 2022 is going to get better or worse?
My crystal ball is not better than anyone else's here. I think it's hard to imagine a world where it gets better. Record low unemployment. And we're about to see an unprecedented pace and rate of rate increases, quantitative tightening, obviously political instability. Now we have monkeypox. I mean, what the hell? Let's add some more into the mix. So
you forgot the war in Ukraine.
It's hard to imagine things will get better. So we're really positioning the company to make sure that we're able to navigate whatever the future may bring. I think it's certainly entering into next year, the environment is a little hard to predict.
But the consumer still seems resilient.
Absolutely. That's why, as I mentioned, I mean, we just published some of this data. We're still seeing, really, really strong performance. And even the early indicators are all continuing to be very positive. And as you mentioned, yes, cost of living is going up, but people are employed, right?
People are employed, yeah. But we are starting to see their savings dip. And the scary thing is that the $50,000 a year and under demographic, their savings have been cut in half.
That's right.
That's a vulnerable population. But even at the upper income levels, you're seeing savings decrease because consumers have been saving and they're now putting their money to work doing things that they couldn't do in the last couple of years. In the few minutes that we have left, Scott, we've talked a lot about what is an uncertain environment and how does that affect the consumer? How does that affect your business? What's the role of a digital marketplace bank in trying to align consumer interest and expectations with the reality of the economic uncertainty? And it sort of suggests that you can look at the glass half empty or the glass half full. I'm going to look at the glass half full because difficult times do make great companies, and we're going through difficult times. I don't think any of us thought we would at this point in 2022, but we are. And so my question for you is, LendingClub has been through some tough times.
You can say that again.
And so for everyone here, what are the lessons that can be taken from your tough times that have created the great company that you are now that others can learn from?
So we did go through some tough times, and we, coming out of that, really let's say we invested an enormous amount of executive time, dollars, technology budget in building a more anti-fragile business. And it was not all sexy, believe me. Conversations at the board of, we want to put in a new loan servicing system when everyone else is launching new products. Right. It doesn't sound great. We want to buy a bank. But what it has done is set us up to be in a place where, we have access to our own funding, stable funding, that is low cost. We are highly profitable. We have a set of recurring interest income that now is independent from loan originations. So in a world where, we'll be potentially tightening credit, we still have a whole income stream coming at us. We have this marketplace where we've really invested in top grading our investor. We have a great mix of investors who've, many of them have been with us for many, many years, and we've created this electronic exchange that allows us to do price discovery and move loans quickly. And we're focusing on a prime quality customer, and as I mentioned, being really thoughtful about how to underwrite them in an environment that is going to be changing. So I feel really good about where we are now. I was going to feel really good about a go-go year that we could take the world by storm. But if things do get more difficult, which, as I mentioned, hard to imagine they won't, I'd rather be us than anyone else, and I feel really great about all the capabilities.
But it sounds like what you did and what a lot of people will be doing now is sort of focusing on the fundamentals of the business, which is not the sexy part of the business, but it is putting a stronger foundation in place for that future. Any particular words of wisdom about the darkest days when you see everyone else doing other things and you're rewiring the plumbing? For us, again, I won't say that it was easy, right? Saying we're going to put in a whole new model hosting system to allow us to do faster testing, which, by the way, great to be able to do price testing in this environment. All of those things were trade-off decisions, and we did it with a company that had some scar tissue and knows things aren't always great. So, for most people over the last, decade plus, capital's been plentiful, and business has been good with a little pandemic interruption. And it's just making sure you're setting yourself up to be, your future self is calling, and what does he wish you did this year? And we have that conversation all the time. Make sure, are we setting ourselves up? What could change? What could be different? And as I mentioned, I think it's set us up well now. What's the best piece of advice you got as you were going through it?
Communicate. It's mostly about getting when a company goes through tough times, getting employees to stay focused and engage and stick with you is all about making sure they understand where you're going and what the other side's going to look like.
Scott, thank you so much for a great conversation. Thanks everyone for being a great audience.
Thank you.